Okay, so we have covered our debt equity ratio, the total asset to debt ratio, and then interest coverage ratio. Now, there is debt to capital employed ratio. After interest coverage ratio, there is debt to capital employed ratio. Now, what is debt to capital employed? Debt to capital employed ratio. Now, debt means long-term debt, and capital employed means capital employed we have already discussed, I think. Yes or no?
Yes, sir.
Capital employed means there is two methods to calculate capital employed. One is asset side approach and the other is liability side approach. So in liability side approach, you write shareholders fund, that is equity share capital, preferential capital, any reserves or undistributed profit, plus long-term debt. And as per the asset side approach, you write total asset, that is non-current assets plus current assets minus current liabilities. This is how you calculate the capital employed. Okay. Now, long-term debt means long-term borrowing plus long-term provision.
Okay, sir.
Long-term provision. So whenever we say debt to capital employed ratio, so capital employed we have not covered yet. Can you check we have completed our capital employed part or not?
Yes, sir. 1 minute, checking. We have done total assets to debt ratio. Yeah, long-term debt we have done, sir.
Yes.
We have done.
Okay.
Solvency ratio.
Let's see. Okay. So if we have covered that, then no problem. Long-term borrowing plus long-term provision divided by, no, not divided by, sorry. Yes. So the formula for debt to capital employed ratio is long-term debt divided by capital employed. Long-term debt divided by capital employed. You know what is the meaning of long-term debt. You know the meaning of capital employed. What will be the formula? So this is our formula for debt to capital employed. Long-term debt is here, this one. and capital employed is here. Okay.
Okay, sir.
Please write this. After that, we will discuss another ratio, another type of ratio, which is activity ratio.
Yes, sir. Done.
So now activity ratio. What is activity ratio? Actually, yes, activity ratio. It is also called performance or turnover ratio. It measures efficiency of enterprise in utilization of its resources. Generally these ratio are expressed in times. Whenever I explain things here, uh, don't write in between that explanation part. Okay, if you want to take the screenshot, you can take it later. If you want to write the concept, you can take it. You can do it also later after explanation. Okay, but in between the explanation part, don't write things because you are not here to write things. You will find all these things in your books. Okay,
Okay, sir.
so first listen to the explanation part. If you don't understand, then ask. And after that, you have to write these things or take this screenshot.
Okay, sir.
Okay. So it is also called performance or turnover ratio. It measures efficiency of enterprise in utilization of its resources. Generally, these ratios are expressed in times. Now, activity means whatever action, whatever work is done by the company. If it is doing anything, it is efficiently doing that thing or not. Means if you are selling your inventory, then you are efficient in that or not. You are converting your inventory into sales or not. The second is trade receivable turnover ratio. You can see here. So trade receivable turnover ratio means how much credit sale is still unpaid at the end of the year. Means how much money you have recovered and how much money is still left for recover. Okay. The third is trade payable turnover ratio, means how efficient in your payment. Means if you are paying the debt or the creditors in time, then they will allow you the future credit. Otherwise, your credit is not good and you'll not receive any credit goods from any creditors. Working capital turnover ratio means how much sale you are doing on the basis of working capital in comparison to working capital, and then average collection period, average payment period is how much time you take to pay the debt, pay the creditors, and how much time you take to receive the amount from debtors. So these are activity ratio. Now we will discuss all these ratio one by one. Can you mute your audio?
Okay, sir.
Okay. Now write these first. After that, we'll discuss one by one.
Sir, I have taken a screenshot.
Now, the first one is inventory turnover ratio. So you can see it established the relationship between cost of revenue from operation, that is cost of goods sold, and average inventory during the period. It measures the efficiency of inventory management. Means uh, how a firm is managing its stock. It shows the number of times amount invested in inventory is rotated. Like you can see here, we are taking cost of revenue from operation, means during the year how much amount we have invested in producing the goods. Let's say we have invested 5 lakh rupees, and at the end there is inventory of 50,000. So it is at the end, but we assume that it is average inventory maintained by the company. It means in a year, company has rotated 10 times its inventory. So it is good. Means company is not carrying the heavy inventory in its go down. So it it doesn't have to incur the carrying cost of the inventory much. So cost of revenue from operation divided by average inventory. So this is a good rotation 10 times during the year. Okay, so this is inventory turnover ratio. Now, in the formula, there is two things: cost of revenue from operation, which is opening stock plus purchase plus direct expenses minus closing stock. Okay, it means cost of goods sold. Whatever the item you have sold, what is their cost? So cost of goods sold. There is another formula: revenue from operation minus gross profit. And after that, what is the formula for average inventory? So it is opening inventory plus closing inventory divided by 2. Okay.
Okay, sir.
Okay. So take the screenshot of this also. And this one also.
So done. Take a screenshot.
Opening inventory plus closing inventory divided by 2 if cost of revenue from operation is not given or cannot be calculated, then revenue from operation can be used. Means there is two things. One is the revenue from operation, that is net sales. Now, in the quotient, either net sale will be given or cost of goods sold or cost of revenue from operation. This is also called revenue from operation. And cost of goods sold is called cost of revenue from operation. Now, in this formula, we have to use cost of revenue from operation, this one. Okay, so you have to see if this information is given in the quotient, then we have to use it. Okay, if it is not given, then we have to calculate it, cost of goods sold. But if any of these two things are not possible, then we will take net sales.
Okay, sir.
Okay. So if cost of goods sold is not given and also it cannot be calculated, then only we will use net sale or revenue from operation in the formula. Okay. So the formula for this is cost of revenue from operation divided by average inventory. So you can use, instead of cost of revenue from operation, you can use the revenue from operation or net sales. So when when there is no information about this, or it cannot be calculated. Average inventory you can easily calculate. Opening inventory plus closing inventory divided by 2. One more thing, if any one of the inventory is given, then you can take that also. Okay, you don't have to calculate average in that case because only one is given, so you will use that inventory here, not average. If opening inventory is given only, then you will write opening inventory.
Okay, sir.
Okay, so this is the first case, inventory turnover ratio. After that, trade receivable turnover ratio. Now, trade receivable turnover ratio shows that how much trade receivable, actually, how much credit sale we have done during the year, and in that sale, how much amount is still not recovered from the debtors. So it shows the relationship between credit revenue from operation, that is net credit sales, and average trade receivable. This ratio indicates the number of times trade receivables are turned over in relation to credit sales. Means how much amount is still recoverable, is still to be recovered. Okay. So trade receivable turnover ratio equals to credit revenue from operation divided by average trade receivable. Now, trade receivable means amount which is to be received from debtors or bills. Okay. So in trade receivable, both are included, debtors and bills receivable. Okay, so if we are writing average trade receivable, it means average debtor plus average bills receivable. Okay, you can write this formula like here. Mm, it is not given actually. Uh, it will be a different formula, that is trade receivable. Trade receivable equals to debtors plus bills receivable. Debtors plus bills receivable. Okay, so this is our trade receivable from formula. Now, opening trade receivable, if it is given, it means opening debtors plus bills, opening bills receivable. And if closing is given, then closing debtors plus closing bills receivable. So opening plus closing divided by 2. This is average. Please write this. After that, we will discuss some question.
Okay, sir. Yes, sir, done.
Okay, so here in this question, mm, Okay, so in this question, the question number 82, actually, this is not a simple question. This is advanced level question, I think. So I will solve this. From the following information, determine opening and closing inventory. Inventory turnover ratio is 5 times. Total sale is 2 lakh. Gross profit ratio is 25%. Closing inventory is more by 4,000 than the opening inventory. Now, first of all, for inventory turnover ratio, what is the formula? It is cost of revenue from operation So inventory turnover ratio, if we have to use this ratio, then we need cost of revenue from operation divided by average inventory. Now, cost of revenue from operation is not given in the question, average inventory is not given. I told you that if it is not given or it cannot be calculated, then we have to use revenue from operation. Now, in this question, you can see total sale is given, revenue from operation, but we have to see, can we calculate cost of revenue from operation? So there is two formula for cost of revenue from operation. Cost of revenue from operation. One was opening stock plus purchase plus direct expenses minus closing stock, and the other is revenue from operation or net sales minus gross profit. So revenue from operation is given in the quotient, that is total sales, and gross profit is also given. So minus gross profit. It is 2 lakh and gross profit ratio is 25. So 2 lakh minus 2 lakh into 25%. Gross profit is generally calculated on sales if there is nothing written with gross profit ratio. So it is just written 25%, not 25% on cost, 25% on anything else. So that's why we are taking it on sales. 2 lakh minus 50,000. So the cost is 1,50,000. Is this clear?
Yes, sir.
Now, if we apply this formula here, inventory turnover ratio, then inventory turnover ratio is given in the quotient, it is 5 times. Here, it is 5 times. So you can write it 5 or you can write 5 by 1. Cost of revenue from operation, we have already calculated, it is 1,50,000. And average inventory, we don't know. So we will write average inventory. Now, average inventory multiplied by 5 divided average inventory equals to 1,50,000 divided by 5. So average inventory is 30,000. Is this clear?
Yes, sir.
Okay. Now the formula of average inventory is opening inventory. Okay, wait. Before writing this formula. Now, there is last information given here. Closing inventory is more by 4,000 than the opening inventory. So closing inventory is more than opening inventory by 4,000. So assume opening inventory as X. Opening inventory as X, or let's say, don't assume X, leave this. Closing inventory is closing inventory equals to opening inventory plus 4,000. We can say this because it is 4,000 more than the opening inventory. So this formula is correct.
Yes, sir.
Okay. Now, if you take opening inventory as X in this situation, then it will be X plus 4,000. Yes or no?
Yes, sir.
So assume opening inventory as X, because actually every time I have to write opening inventory, it will be short. So X. So it will be X plus 4,000. Closing inventory equals to. Now, average inventory equals to opening inventory plus closing inventory. Plus closing inventory divided by 2. Average inventory we have already calculated. It is 30,000. Here you can see 30,000 average inventory equals to 30,000 plus opening inventory. We have assumed it as X, and closing inventory is X plus 4,000 divided by 2. Now 30,000 into 2, 60,000, because cross multiplication is done. Whenever this is written like this, 1 will be multiplied with this part and 30,000 with 2. So 60,000 equals to X plus, sorry, 2X plus 4,000. Now 60,000 minus 4,000 equals to 2x, because 4,000 is positive this side, so it will go to the left side and it will become negative 4,000. So 2x equals to 56,000 and x equal to 56 divided by 2, that is 28,000. Okay, now opening inventory we have calculated, and closing inventory is 4,000 more than the opening inventory. So can you tell me the amount of closing inventory?
1,000.
Yes,
3,000.
3,000. How you are getting 3,000?
I think we have done it up.
Yes.
I think we have done it up before 30,000 divided by 1 is equals to x plus x.
Where?
Okay, closing inventory we're finding.
Yes, we are finding closing inventory. So what will be the amount here? It is written in the quotient that it is more than 4,000 more than the opening inventory.
So 28,000 plus 4,000.
Yes. 28,000 plus 4,000, it will be 32,000.
Yes.
This is how we solve these type of question. So see this question, and because these type of question is generally asked in examination, this is very important. So maybe not inventory turnover ratio, but the other for other ratio portion of these type can be asked. So please understand this concept, and then you have to solve.
Okay, sir.
You want to write this?
I'm taking screenshot. Second, scroll down. Yes, sir. Yes, sir. Done. Yes, sir. Done.
Now, take the question number 86 and calculate the required thing that is asked in question.
86.
Yes.
Okay, sir. Sir, I'm getting 11,000.
Okay.
I'm getting 11,000.
Your answer is 11,000.
Yes.
Okay. So what have you done in this question?
I found average trade receivable, open trade receivable plus closing trade receivable divided by 2.
Okay. Opening trade receivable is
Uh, 7,000
7,000. Where you find this opening trade receivable?
in bills receivable.
That is not correct. What I told you before this, before solving this question.
And address plus bills receivable.
Then
Okay, sir. So can you show the question? So I'm getting 37,500.
what?
37,500.
This is your
The final answer.
final answer.
Yes.
Okay. So what is your opening trade receivable?
Open trade receivable it is 35,000,
Closing
40,000.
40,000. And average?
So average I didn't find.
Then, okay, what is the question asking?
Calculate trade receivables turnover ratio from the following information.
Okay. So what is the formula of trade receivable turnover ratio?
It is credit revenue from operation divided by average receivable.
Okay. So credit uh, revenue from operation you got
37,500.
37,500. Credit revenue from operation.
Yes, sir. For adding debtors plus bills receivable.
This is the revenue from operation. What are you doing? I'm saying revenue from operation. You are telling me trade receivable.
Revenue.
The answer will be uh, 28,000 plus 7,000, that is 35,000, is opening.
Yes.
25,000 plus 15,000, it is closing. Average is 35,000 plus 40,000. divided by 2, that is 75,000 divided by 2, and which is 37,500. This is average trade receivable. Now, we need credit sales. So total sales minus cash sale, it will be 1 lakh is total sale, and from that, if we remove cash sale, we will get 76,500, and from this, if we remove 1,500 of sales return, then we will get net credit sale, that is 75,000. So 75,000 is credit revenue from operation divided by average inventory, that is 37,500. It is 2 times. So just think about the quotient, what is it asking, and then apply the formula. You cannot say whatever you get in your answer, you cannot say this is the answer.
Okay, sir. The total cash revenue identified.
Okay.